All right, let's talk FNB Corporation. They just dropped their fourth quarter numbers, and the market gave them a pretty big thumbs up. So we're going to break down exactly what powered this quarter and figure out what it all means for the next trade.
Okay, let's get right to the headline number. FNB delivered operating earnings per share of 50 cents. Now that is a solid 9-cent beat over what the analysts were expecting. And let me tell you, in this kind of market, a beat that big? Yeah, that's going to turn some heads on Wall Street.
And here's the proof, right? You can see exactly how the market felt about it. The stock shot up, closing the day up around 3%. Investors loved what they saw, and a jump like that is a huge vote of confidence that the bank is on the right track.
So we've got a big earnings beat and a happy stock pop. Great, but why? What was really going on under the hood here? Let's dig into the financials and see what drove this thing.
All right, and this is where the plot thickens a little bit. You look at the top-line number, revenue, and it came in at about $458 million. Now, technically, that's a tiny, tiny miss. So you have to ask yourself, right? If revenue wasn't the big story, where on earth did that huge earnings beat come from?
Well, first thing you got to remember is that context is king. That miss was so small that the market basically shrugged and called it in line. Nobody was really punishing them for it, because the real story, the secret sauce for this quarter, wasn't on the top line at all. It was all about profitability. And here we go. This is really the heart of the bull case for FNB this quarter. Look at this. Net interest income, a record high. Boom. Net interest margin, up to 3.28%. That's a 24 basis point jump year over year, which is fantastic. And then you look at risk. Net charge-offs at just 0.19%. That's just squeaky clean. It screams that they're being super disciplined. And to cap it all off, a record capital ratio. This is a picture of a bank firing on all cylinders.
So, okay, the numbers look great. But what's the story behind the numbers? Well, management is really pushing what they're calling a self-help story. The idea is they're not just waiting for the economy to help them out, they're taking control with internal improvements and a really tech-forward game plan.
It really breaks down into three key things. 1, take all that profit they're making and use it to build up even more capital. 2, get their balance sheet ready for whatever's coming next. They are being proactive. And 3, and this one is huge for the future, they are going all in on tech, AI, and data.
And the CEO, Vince Daly, he said it himself on the call. He made it super clear these aren't just fancy buzzwords they're throwing around. They are connecting these tech investments to a very real outcome, cutting costs and getting more efficient next year. It's all about making every dollar work harder for them.
And if you want a perfect example of what that proactive management looks like, here it is. They moved around $200 million in mortgages, getting them ready to sell off in Q1. Now, this is not some desperate fire sale. No. This is a smart, strategic play to manage their portfolio, free up some cash, and give themselves more options for 2026.
So all of this really sets the stage for what's coming next. What is management actually telling investors to expect for the rest of the year? Let's get into their official guidance for 2026.
Okay, here are the numbers they're putting out there. They're telling us to expect mid-single-digit growth for both loans and deposits. Pretty solid. You're looking at net interest income somewhere around $1.5 billion, which is a really strong target. And importantly, they're signaling they're going to keep a tight lid on expenses, which, as we just said, is absolutely key to making that whole efficiency play work. Okay, now here's the fine print, and this is really important. Every single number we just looked at, it's all based on one huge assumption, that the Fed is going to cut rates twice in 2026, once in April and once in October. If that doesn't happen, well, then all these numbers are going to change. So for anyone watching this stock, that's the number one thing to keep an eye on. All right, we've looked at the quarter, we've looked at the strategy, we've looked at the guidance. Now let's put it all together. It's time to make a decision. This is the next call.
So what's the bottom line? After digging through all of this, what's the actual trade?
We're rating this in outperform. Plain and simple, we think this stock has what it takes to beat the market based on everything we heard and saw in this report.
And here's the thinking behind that rating. It really comes down to 4 key things. First, you've got proven discipline. Their credit quality is just rock solid, and the moves they're making with their balance sheet are smart. That just lowers the risk. Second, they have incredible capital flexibility. That 11.4% capital ratio, that's like a war chest. It gives them so many options. Third, that self-help story, it's legit. The tech stuff isn't just talk. It's set up to deliver real savings. And finally, number 4, it's all pointing towards shareholder returns.
Management is basically sending up flares that buybacks and maybe even dividend hikes could become.
And you know what? This one quote from the Q&A part of the call just says it all. You're hearing from a management team that is clearly confident. They know they have the capital, and they're completely focused on one thing, using that money to create value for their shareholders. I mean, it doesn't get much better than that.
And of course, just a reminder, this is not financial advice.